welcome everybody to the Pension Board meeting. We'll call the meeting to order. It's 7:01. So the first item on our agenda for this evening is our public participation, and it does not appear that we have anybody here, so we'll move on from there. The next item on the agenda is to review and approve the minutes from our meeting of May the 17th. And hopefully the minutes were sent out to everybody. Hopefully everybody had a chance to take a look at them. Give you a second, if not.
Do you need separate motions for the joint meeting as well as the separate meeting, or is one motion for both acceptable?
I think one motion for both should be acceptable.
Barring any questions, I move to approve both the joint meeting and the separate meeting of the Pension Commission for May 17th, 2021.
Second. Is any questions, comments, revisions? If none, then all in favor, signify say aye. Aye. Any opposed? None? Great. So minutes are approved. Next item on our agenda, welcome Michelle Froman, here to present the actuarial information. So Michelle, I'll turn it over to you.
All right, thank you. As we discussed before getting started, we're going to jump to the very end of the presentation. This is the same information that was presented at the previous meeting from the minutes that were just approved. But what you asked me to do at the end of the previous meeting was to look at the results if you were to lower the discount rate from 6.25% to 6%. So that's the one change from the previous information is on page 6. We've added one column that shows lower the interest rate. Let's start by looking at the police pension plan. So the results previously at 6.25% were showing $32.7 million in accrued liability. If we lower the discount rate to 6%, we're going to increase the accrued liability to $33.7 million. This means a decrease in your funded ratio from 55.9% to 54.3%. And then going down to the bottom line, that means an increase in your actuarially determined contribution from $1.9 million to just over $2 million. And just to remind you, these are all figures as of January 1st, 2021. So we're looking back at the very beginning of this year. We're looking at asset values as of the beginning of this year. So everything that Chris is going to present about the wonderful results through June 30 are not reflected in these numbers. But so we'll take a trip back in time to January 1st. This is the modest impact if you were to continue to lower the discount rate. And what we talked about back in May was that it's not necessary at this time to lower the discount rate from 6.25 to 6%. It is consistent with the conservative approach that you have been taking to continue to lower the discount rate. And knowing how well the market is performing, it's one of those interesting opportunities where you feel like, no, that clearly supports a much higher discount rate over time. We're going to keep earning 33% every year. I wish, because oh boy, could I retire in style. But it's actually one of those great opportunities to lower your discount rate because you know that your asset value is going to be a little bit higher. So looking forward to January 1st, 2022, assuming that the assets stay on a consistent basis, then you're going to have a little bit more room in your funded ratio if you were to lower the discount rate a little bit. So it's a little bit of offsetting and saying, okay, we might be able to afford this lowered discount rate. And then by lowering the discount rate, you're setting yourself up to be able to pursue slightly more conservative options in the market as well. And knowing that both of your populations are predominantly inactive, you have almost no actives left, you want to be able to move to more conservative portfolio, and you want to be able to support a lower discount rate. In the end, whether you decide to move for January 1, 2021, or you wait until 2022, or even until 2023, you're most likely going to be lowering your discount rate in the future. Yes.
Hi, Michelle. Question. First of all, thank you for the explanation. And as I think you know, I'm one of those that does support lowering the discount rate. I think the 6.00 discount rate at this point will do exactly what you just said. We're going to be in really good shape, and I think that what we've done over several years is lower it 0.25% or abouts each year, and I think hopefully we get to this plateau now of 6%, and as you said, with an aging population, a closed plan, not only will we be able to make life a lot easier budget-wise in the future, but also will bring our funded ratio up as we move forward without continuing to lower the discount rate. And I'd rather do it now, like you said, when things are good, rather than chasing it later when things are not so good and seeing even a bigger increase at that time. The question I have is, can you remind everyone about the phase-in and how that affects the amount that we are contributing right now or going to contribute?
Absolutely. So the phase-in was something that was introduced for the January 1st, 2020 valuation. And what that was reflecting an updated mortality table. Prior to January 1, 2020, you were using an older mortality table, but the Society of Actuaries did a wonderful study finally focusing on public plan mortality and found the unfortunate results from a pension plan perspective that your public plan employees are living longer. And so living longer from a public pension plan perspective means paying benefits for longer, higher liabilities. And so to ease a little bit of that pain of reflecting this updated, more conservative mortality table, you chose to not fully address that actuarially determined contribution for the January 1, 2020 valuation, which is paid in fiscal year 2021, 2022. You're phasing it in. So that's actually 50% of the increase to do the 1.791 versus the 1.9, which was the full calculation. But if we look from January 1, 2020 to January 1, 2021, it actually stayed very stable, your phased-in actually determined contribution. We expected a higher contribution when we were back in 2020. But based on the performance of your assets and the performance of your population, meaning deaths, people terminating, retiring, we had a slightly lower ADC than we expected. So that was the intention of the phase-in, to not fully reflect it.
So just to clarify, on the police plan, then, it was approximately $1.8 million that we put into last budget, and it's going to go from 1.8 to basically $2 million in next year's budget. Would that be a correct statement?
If you move to the 6% discount rate, correct.
Yeah, right, I got it.
Yes.
Thank you.
I guess I'm somewhat inclined to wait until we've finished that 2-year phase-in of the actuarial adjustment and then perhaps change down to 6% the following year, just to, again, to sort of smooth all the changes that we're taking on, but it's not a strongly held position.
Well, my question would be more to John that, I mean, right now, between the two plans from a budget perspective, and I understand getting to where we are, our returns, everything else, but from a pure budget perspective, we're looking at an increase of about $150,000, just staying at the 6.25 in terms of the annual contribution. Going to 6% would be, and it looks like an additional, for both plans, additional 120-something thousand on top of that. So from looking at everything for the budget and where we are, what, John, do you see? Is that being a difficulty? I mean, any increase is a difficulty, I understand, but how does that play into budget?
It's really your call. I mean, if you bring it down to 6%, that's the number it is that goes in the budget. When we put the budget together at the beginning of the year and different departments are looking for $3.5 million increases, the Board of Finance starts looking to where they could shop the increases. This wouldn't be a spot where they could shop it. I wouldn't allow them to do it, and their chairman, our chairman of the Board of Finance, probably wouldn't want to do that either, because he understands the responsibility of putting in the contributions that you're either gonna pay now or you're gonna get whacked in the future for it. I mean, is any increase good in a budget year? No, but, I mean, we have to live with it. And they try and offset the increases with what they wanna have to increase the taxes with. And the only concern I would have, and this isn't just with the pension, it's across the board with budget. We're coming off a year with COVID and a lot of people were out of work. At one point in time, we even had a 10% unemployment rate, I believe, in this town. If we could stretch out even for 1 year, the tax increase, if there'll be one, to try and keep it all level, that's a good thing. But it's really up to you as a board to decide that.
Michelle, I guess my other question is, just in terms of where we are rate-wise, our kind of peer towns, also against how we are funded versus peer town, where do we stand just kind of?
From a discount rate perspective, you have always been in the forefront of conservatism from my experience. But there's a reason for that, and it's because you have a predominantly inactive population. You've been closed for so many years that you should be at the forefront of lowering the discount rate just because you don't have the active employees. You want to be in a better funded position and have slightly more conservative assumptions because of the inactive population. From a funded ratio perspective, because of that conservatism, you're on the slightly lower end. But if we were to compare on the same basis, then I think you would be either, if not equal, ahead, because you've been so responsible in that conservatism and taking a realistic approach of what long-term asset returns are likely to be.
So I guess, any other comments, questions? I mean, my feeling is, I think similar, that we've taken some big bites, and yes, we have to get there. Kind of understanding where John is, just budget pressures, and while I do agree that yes, what we do, the board of finance would go along with. There's a lot of push and pull on other pressures on the budget, and I mean, this isn't that we don't do anything, it goes away. It's just a matter of how do we all live within the reality of the constraints, and do we, as you say, take a breath and kind of get this phase in done and push it off a year, and go and take a bite as opposed to kind of pushing this in. I guess thoughts on that, Mitch? And
I mean, I respect the opinions of others. I just think that, as Michelle said before, and while she's not pushing, I understand she's not pushing the 6%. I think it is just the right thing to do at this point, and then I think it's going to set us up much better for the future. It'll make future budgets that much easier. The extra money this year will just put us in a very, very good position. I like being at the forefront when it comes to this. We were one of the first towns in the state to close out our plan, but we have to make sure we fund it properly. And, that's one thing that I've been proud of, being on this board for so long, and the Board of Selectmen, that the town of Orange has funded the ADC year after year. And, I think we're going to have an increase, obviously, from what we're looking at. So I think it's a little bit more of a bite, but I think it's going to position us much better going forward. So I would still support moving to the 6% at this point. And then hopefully we are done with having this discussion for years to come instead of stretching it out.
I make no promises that we will be done with having this discussion.
Well, with that comment, it's even more important, I think, that we do it now, because we could be chasing our tail if we don't do it years down the line, saying, we should have lowered to 6. I think we're going to, I'm not the expert. You are, and you are, but I think we're going to be in much better shape being at 6, and then, we won't be chasing it later, hopefully, and I if we have to, we're that much closer, and we won't be further behind.
It's very hard to prognosticate with such a small census. That's the problem we have. There are just like 1 death or 2 retirements, and we're in a completely different dimension. I just feel that because we're taking an extra bite this year, and because it's been a difficult year, there are still unleased buildings and so forth. I fully support being in the vanguard. I just would like to wait a year to be in the vanguard.
John, one other question. This was all January 1st. We don't have a big active population. Has there been any other?
I can't hear you with the thing.
Oh, since have there been more retirements, or are you aware of any other retirements?
Not in the police department. I think we have 3 people still active there.
Yep.
So that's the police chief, assistant police chief, and 1 lieutenant. That's it over on the police side of it. What do we have on the town side? 4. That would be assistant assistant finance director, assistant town clerk, and 2 people, I believe, up in public works. That would be the 4 there. When any of those people are going to retire, within probably next 5 years, most of them, probably 9 out of the 90% of them. 1 might be a little longer.
Yep. But nothing since January 1st is.
No,
So we're stable.
they're stable.
I guess that's a good thing. So I guess to proceed, if for consideration, first of all, is there any other questions of Michelle or Chris? Would you have anything to comment on?
No, I would, just as a recollection for the committee, I think similar to what Michelle had shown, right, the current allocation with our inputs models to something akin to 6, just about 6, a little short of that, if you remember, absent any manager contribution. So I think that's the 6% number that you're targeting is certainly within the realm of reason based on your standing allocations. And I think everything Michelle said from a broader perspective in terms of your comparisons is very accurate as well. In terms of you're certainly among the municipalities I service down toward the bottom end from a discount rate standpoint. And I think, as mentioned, if you trued that up and did an apples-to-apples comparison, your funded ratios would be, right in the ballpark as well. So beyond that, Mr. Chairman, don't have a lot to add.
Thanks. Rebecca, any?
I just had a question. I guess this would be for John. So just thinking about this from a budget perspective again, if we did increase, if we move to this increase, would you foresee this increase, the burden of this increase going to the taxpayers, or the burden going to town departments to lower their budgets to offset the increase?
That's a hard question to answer, though.
I know.
Going by my past experience with the Board of Finance, it could be both.
Mm-hmm.
They go in with the idea that they don't want to raise the tax rate every year. And when you put all the departments together, especially the school systems, the 2 school systems, and the problems they foresee with Amity every year with the surpluses, they feel that a lot of times with Amity surplus, we're raising taxes where we shouldn't be, that their budget is higher. But there again, it's their budget and it passes in a referendum, so it just becomes, just like it really is, it becomes a plug in the budget, in the town budget. And if they only want to raise taxes 2% and the expenses are up 3%, it's going to fall to the taxpayers. we look through the different departments, looking to cut the budgets for, say, you have a big line item in your budget for part-time help in the library, and they've looked at that in the past and trimmed it a little bit, and you know what the consequences of that could be. The pool, the same thing. The other problem we're having with the budget, and Nick knows this very well from Guilford too, the minimum wage has been going up $1 each year. Well, it's not, it doesn't cost the towns just $1 at the bottom level. If we're using the pool as an example again, you have children, I won't call them children, young adults that come in as lifeguards that start at the minimum wage. And then if they've been there 3 years, they make, I think, $1.50 more above that. And if they've been there 6 years, which there are some that have, they make another $1.50 above that. So when that minimum wage goes up, you got to keep that spread between the groups. So it's not really a minimum wage increase for the lower half. It's a minimum wage increase for everybody. And again, as Mitch knows, we're not one of the more liberal towns when it comes to hourly wages for some of the part-time personnel and all. And we've had to look at a lot of those positions, even the non-union positions, and they raise some of those, which we did in July.
Yeah. Thank you. Yeah, I just keep thinking, if we move to make this change, you know, being a little bit more aggressive, I can't see any way that the taxpayers won't either have a tax increase or lose out on services, right?
But I can't guarantee you that you don't make this change, that there isn't going to be a tax increase either. I don't want,
Oh, sure,
I don't
no,
want you
I'm-
to get that in.
I'm
that
not implying
impression.
that our decision
Yeah.
will have any concrete bearing on the tax burden or services, but just, you know, theoretically, any increase that we see either results in an increase to taxes or a cut to something, right?
So
John, if I can, Jerry, I want to follow up Rebecca's question, though.
Yeah.
But John, I mean, I know it's too early to start predicting next year's tax increases. We just got finished with our tax bill this year. But this is the year we're going to have the American Rescue Plan monies that will hopefully offset some other increases. I would expect this would be, quite frankly, an easier year for the budget than we've seen ever before, with the amount of money coming in that will be used to offset certain other things that would normally be in the budget. I know you can't predict what the Board of Finance is going to do and where that money's going to go, but there's a large pot of money that can't be used to balance a budget. But it can be used for certain projects that would have been put in the budget, or maybe partially in the budget, but then, you know, will be able to be funded because that money's coming into the town, and we got to spend it.
You're probably talking about capital projects, so that aren't normally in the budget.
Right, but capital projects are a huge part of, the capital projects far outweigh the increase we're talking about here. Overall.
Yes.
Sorry, Michelle, I cut you off.
No, you're fine. One thing to consider too, though, it might be a slight short-term pain, but with a pension plan, it's always pay me now, pay me later. In the end, you are making those pension payments because they've been promised. And so you don't want to have retired police officers suddenly not able to collect a pension check. I mean, clearly you're not at that point, but in the extreme version, you want to make sure that those pension benefits are being paid. And so if there's potentially extra budget flexibility now, then putting in a little bit more contribution today actually saves taxpayers down the line. So just balancing it all.
And that's actually one thing that the Board of Finance talked about over the last couple of years. I think you and I even might have had a discussion about that. They talked about taking $1 million, I think it was $1 million at one time, and putting it into the pension plan I think it was coming back as a surplus from Amity at the time, and then they decided putting capital, I believe, instead. But it was something that they did think about, and it can be brought up in the future to them again.
Sure, and we've had that discussion even from the standpoint of going back several years ago, the town would typically make the pension contribution towards the end of the fiscal year.
Right.
And we switched it to making it at the beginning of the fiscal
Right.
year, understanding that if we make a $2 million contribution, theoretically, there's a 6% or 6.25% earning that's already built in because that money is there a year longer than it would otherwise be. So, yes, Michelle, you're absolutely right. The money goes in, it's earning that much sooner than it would otherwise go, so it's not only the contribution, but all those future earnings on that contribution that go along with it.
And that did happen again this year, Eric.
Yes. Yeah, I know that our contribution has been funded for the year.
Usually, since I've been here now, we usually get it out as soon as we've collected enough taxes in July to cover those two payments. And that's usually third week in July, something like that.
Yeah.
And
So,
I see no reason why that shouldn't continue either, just as a.
Do we want to look at the town side numbers? I mean, they're much smaller than the police.
yes, yeah, why don't we go to the town?
Representation,
I know. Well, we said there would be questions. The town numbers are very similar to the police, just on a smaller scale. So at 6.25%, we were looking at 11.2 million in accrued liability. If we drop to 6%, then it's 11.4 million in accrued liability, moving your funded ratio from 68.1 to 66.8. And this isn't something I pointed out on the police, but you can see it on the town as well. From 1/1/20 to 1/1/2021, even if you lower your discount rate, you're still seeing an improvement in your funded ratio. So we're still looking better even with a lower discount rate. The impact on the actuarially determined contribution is about $20,000, going from 609 to 629.
So
You ready for a motion?
I'm ready either for further discussion, questions, or a motion.
All right, I'll try a motion, we'll see where we go. I will make a motion that we do lower our discount rate from 6.25 to 6.00 and make the actuarially determined contribution to both plans in the next fiscal year.
Is there a second?
Second.
Thank you. Is there any discussion on the motion?
I just want to be clear, when you say the next fiscal year, you mean not the current fiscal year, but
Right.
2022 to 20,
John will correct me if I'm wrong, but the numbers we're talking about right now
Are for
will be for
2022.
2022, 2023.
Right.
We've already made the contribution for this fiscal year, so this will be into the next. We're
Sure.
very proactive here in August, thinking about next July.
Maybe you could just modify your motion to say for the fiscal year starting July
Joe,
1st,
2022?
2022.
So changed, and I'm sure Barbara would accept that.
Second as amended.
Thank you, and thank you for the clarification on the budget year. If no other questions or comments, then we'll vote on the proposal. So those in favor of the motion as amended, signify by saying aye.
Aye.
Aye. Those opposed? Oh,
I'll change to
that's an aye. Sorry. Those opposed?
1A.
One nay. So we have 3 in favor, 1 opposed. The motion carries. So we'll make that change to the 6.25, lowering from 6.25 to 6%. That will be effective for the budget year beginning July 1st, 2022.
I have my first new number for the new budget.
Honestly, not that bad. If I can just comment, I think Michelle's last statement was very, very telling, is that I've seen this for years and years and years as we keep lowering the interest rate, which has been the right thing to do, even discounting what we just did. We always see the funded ratio going down, which seems counterproductive. And to finally see it taking that turn, I think when we hit that 6.0 plateau, I believe, honestly, going forward, the next several years, we'll be able to see our funded ratio rise, and I hope we don't have to lower the interest rate again for a long time, if at all, because Chris is going to continue to make us all kinds of money in the investments.
You'll see for the 1 year ending in June, we'll take that all day.
Michelle, anything else to add to your report?
No, nothing else to add. Based on the approved motion of 6%, I'll finalize the valuation reports.
Thank you, and thank you for your presentation. Yeah.
Since we didn't meet, you all got them.
So next on our agenda, we'll turn it over to Chris from Fiducian, who will tell us how we're just making a lot of money, and that will help our contributions going
Yeah,
forward.
we'll see. Well, good evening, everyone. I think Barbara's online. John, you have a copy. Mitch has a copy. Ricky, you've got a copy, and you're...
I'm actually sure because it didn't work for me.
All right, let me see if I can do this. So you've got a visual there. This, so we'll hit the highlights here and keep you on task. The first several pages, I'm not going to go through, but pages 2 and 3 in the report, you'll see a couple of things. One is just a reminder for the board, right? We are producing lots of collateral. The best place to find a lot of that's on our website, fiducianadvisors.com. So if you're inclined and you see a topic of interest, and we're trying to kind of drip that on you as well, just lots of stuff coming out of our research group and other business units to keep you up to speed on things. So just a reminder there. And then we do continue to hire. You see on the bottom of page 3 there, we've hired 10 some odd people in the new year alone, and are looking for more, I think, like lots of employers are, and just continue to resource in a manner that supports our growth, and do so, more importantly, so that we're not deteriorating the services that you folks are receiving in any manner, right? So we've got ample resources to handle that growth. If we skip ahead to slide 5, governance this quarter in the upper right-hand corner of the page just relates to the policy statements and some fiduciary training. I'll be kind of quick to the punch here if no one objects. If you jump to slide 8, you'll see just a checklist there of kind of elements of a good working IPS, and you see there you're checked off, and I think in good working order. We've included copies of the town and the police IPSs in the packets for you. No recommendations for changes this evening. I think that the plans, or the IPSs rather, are set up to be effective blueprints for what you're trying to achieve, and don't need to make any changes. So if no one objects there, it's just really a simple reaffirmation from us that they're in good working order. And again, they're kind of voluminous here. Bear with me, if you would. They're included again, if you're inclined to look at those. And then I'm going to skip ahead just quickly to slide 24. And just a reminder, this group has always been very diligent, I think very disciplined, very structured with the way you've organized your committee, with the governance protocols you have in place in terms of meeting agendas and its frequency of meetings, and following the governance calendar that we utilize to make sure attending to everything, having the IPS and the like. So you're really doing, from our standpoint, on the fiduciary front, everything that you should be doing. And again, no recommendations for changes there. You folks have always done a great job on that front. And certainly you build this over time, right, this reservoir of information. So if anyone were to come from the outside to say, what'd you talk about? What were the decisions you made? What were the input to those decisions? What's the research you relied on? You're obviously cataloging all that, and certainly I think your protocols would stand up to any scrutiny that you would ever encounter. So you're in great shape on that front. Any questions from a governance perspective, IPS or just framework, governance, fiduciary framework? Anything from the committee? It's relatively straightforward, I think. And then we'll spend just a minute or two here, if no one objects, on slide 25. You'll see there in the upper left-hand corner just a couple of things. It's interesting, right? So we have had, admittedly, just a kind of a zany year, both macroeconomically and in the markets, as we'll see in a minute. And look at the upper right-hand corner of the graphic there. We don't have to get into the details and too much granularity, but you see there, this is GDP. And the blue line is dark blue line is 2020, and you all remember right back in the spring of that year, the big downdraft in GDP output, which was unprecedented, really. And moreover, look at the V-shaped recovery and recovering all that output and then some on the other side has been as rapid as we've ever experienced in history as well. So really just kind of amazing, the momentum in the in the economic kind of factors, if you will, that have been driving markets, which we'll see in a minute. Lots of talk from the Fed, right, about stimulus and what to do with it. This Delta variant obviously has put a little bit of a wrinkle into the pace at which they may begin to remove some of that stimulus. We think on balance it remains pretty accommodative the way it has been. And hopefully we'll continue to make inroads on the vaccination front. And we think, all things considered, you bring that all together, that we still think for the next several quarters that on balance we're going to see economic momentum continue. And the economy continue to grow around the world. Lots of chatter in the press about inflation, right? You saw certainly in the spring this talk of supply chains jamming up and prices going up and people can't find new cars and all these things that you've been reading about, which has since started to settle down a little bit, actually. And we do think, which is the Fed's indication as well, which we agree with, we had very low inflation prior to the pandemic. We've had this spike, and the economy is starting to adjust to that spike. And we do think on a run rate basis, once the recovery begins to kind of take hold again, that inflation will run higher than it had been for some time, but not to a level that we think would cut off the economy or derail the recovery.
I just have a quick question, just parsing out from the overall inflation to specifically supply chain issues. Are those easing up some, or are there still going to be no chips for the foreseeable?
Yeah, the anecdotes are, Barbara, that they're starting to ease up. And you are starting to see recalibrations in industries and people adjusting and things starting to come. The markets ultimately in economies, as you know, figure it out. Think back to the onset of the pandemic, right, where you couldn't find paper towels and toilet paper. And when you could, the prices were ridiculous, right? And it took a couple of months, but then the recovery started to, take hold and the supply chain recalibrated and things started to settle down. And you've seen that in chips, like you said, and it's been challenging for the car industry. But there are new production coming online and things seem to be starting to soften up. And when you look at some of the input prices, they are starting to kind of moderate a little bit in terms of the gains. So I think ultimately it does, the economy does kind of recalibrate.
Chris, on the other point on that is, I mean, we're seeing not only locally, but with our clients, a tremendous amount of wage inflation, which is not temporary. It becomes permanent, but is really a lead to what could become, or what probably will become, higher prices, because as those wages will get baked in. So, what do you see on more of a macro level on that? It's that's not the commodity side, that's the wage side of the equation.
So I think that's a contributor, Mitch, right, to this idea that on a go-forward basis that inflation is going to be a touch elevated from what it's been. And remember, we didn't have those wage pressures, right, prior to the pandemic, and we certainly do now. So I think kind of a part and parcel to this idea that inflation is going to run a little bit higher and more towards the targets that the Fed's comfortable with, which, depending on how you measure it, is 2.5%, something like that. So that'll certainly be that wage influence will certainly be kind of an input to those higher expectations on the inflation front. Excuse me. And then the final thing in the lower right-hand corner, we've talked about this, I think, at our last two meetings, but important to remind everyone, you'll see just the exhibit of capital asset class returns, excuse me. Lost my cursor, here we go. And they're much broader than they've been, right? Remember when we talked about, I think at our spring meeting, the stocks that really worked coming out of the recovery early on were the big glamour names, the large cap tech names, for example, were phenomenal. Everything else wasn't doing as well. And now you've started to see much broader returns with small cap stocks. That's the Russell 2000 number you see there. The value as a style has come back a little bit. And that's important for us, right? Because historically, that type of broader pattern of returns is associated with the macroeconomic momentum that we still think is in place and the backdrop we think is still constructive. You mix this all together. And we do think that you'll see in a minute, right? The returns have been just spectacular and probably not quite at the levels going forward that we've had recently. But nonetheless, we do still think investing will prove to be kind of a productive exercise and that markets can move a little bit higher still. We've got very low interest rates, right, which is going to challenge the fixed income portion of the portfolio. Valuations on the equity front are a bit elevated. We need to be mindful of that. So we'll probably have some peaks and valleys here, but there is a lot of pent-up, we think, momentum in the economy, and that backdrop should remain favorable, again, assuming we can get through this variant situation, on somewhat of an even keel. I'm going to jump, if no one has more questions on kind of the big picture, jump to page 27 just quickly, and we'll frame some of the returns we've seen before we look at the portfolio and the performance. So what we've done here on this page, if you can make it out, you'll see the number encircled for each of the asset classes is what happened in the second quarter, and the blue bars, or or depending on the asset class, the vertical bars, are year-to-date numbers. So U.S. core bonds, the third asset class in from the left there, you'll see kind of interestingly enough are actually through June still down year-to-date a little bit. Remember, interest rates moved up pretty higher at the beginning of the year, and that's a headwind for fixed income returns. They've since come down in the second quarter, and you see the positive return there associated with that. So fixed income, kind of a wash, if you will, so far calendar year to date. The equity markets in the middle of the page, right, continue to be pretty robust. 15% for large cap stocks in the U.S., almost 18% for small cap stocks. International stocks, kind of holding serve there, up 8 and change and 7 and change. And then kind of the reopening asset classes, as we've come to label them, things like REITs and commodities and real assets, you see to the far right there, doing pretty well. Again, the backdrop there being that as the world begins to reopen, there's a lot of demand for those type of those asset classes, and they get bid up, and you've certainly seen that in the first 2 quarters. So that is just a quick backdrop on broadly on the markets. I'm going to set aside the detailed collateral, if no one objects, which are the next several pages. I'm going to jump right to the portfolio, which is on page 33. So you'll see here, this is the portfolio at the end of June. So these are the collective assets of the two plans, close to $29 million. John alluded to it, and we did work with Mitch with putting the contribution to work early in August. Most of that contribution here, probably no surprise to the committee, went to fixed income, right? Because you see a little bit of an underweight there versus the target, so we restored those targets, those balances. Working with Eric. Did I say Mitch? I'm sorry, Mitch. Mitch is Guilford. Milford, yeah, Eric is Orange. I got the towns mixed up. I do know you guys are considered demographically similar towns and peer towns, so I must have mixed that up. But thanks, Mitch. So we did put most of that money into fixed income and then set aside some liquidity as well. So I think as we stand here tonight, from an allocation perspective, we're back very close to target, and I think we're in good working order. From a status standpoint, this is always a good visual page to give you that summary. Everything's on maintain with one exception, and that one exception is the Dodge and Cox International Stock Fund. As you'll see in a minute, it's certainly not for performance reasons, but we have elevated the strategy to our kind of new status designation of discuss. What does that discuss mean? Dodge and Cox has a long-standing history of when their folks reach a certain age, they retire. And they've had two individuals who were part of the portfolio management team for that strategy, who just retired recently. They've always done a terrific job of telegraphing that, of having very effective succession plans, of training new people to come on into those strategies, and we think they've done that again here. So I suspect that discuss status will be removed pretty quickly, but it is a change, and we wanted you to know about it. No action item for the committee to contemplate this evening, but wanted to just let you know that we did have that one status change in the quarter. Otherwise, we're in good working order. And then to the star of the show here on page 34. You'll see the numbers. I'm looking at the elongated rectangle in the middle of the page there. So you see for the second quarter, the portfolio is up 5.7%, a bit north of the blended benchmark, and year-to-date up 7.8%, a bit ahead of the benchmark. And then the one-year number there, that's not a typo that you see. The plan was up a full over 27%. For the one-year period ending in June. So pretty healthy returns across the board. And I'm trying to think back using the bottom exhibit, just using the calendar year numbers. I know it's not a perfect representation, but I'm trying to think back of how many 12-month periods we've had with a return like 27%. There haven't been too many. And you can see there actually down on the bottom using calendar year barometers, there haven't been any over the last decade near that. So pretty splendid activity in the capital markets, and the managers certainly contributing along the way here, and the evidence of that, if you scroll ahead, what we always kind of look at and find of interest to the next page, you'll see on 35 there, the individual details. And what I'd point your attention to, again, move to the third column in from the left. Let's use the one-year numbers because I think they tell the story most effectively. Remember what we do here, we kind of roll up your underlying managers in each asset class to a subcomposite. So you see over the last year, the bond markets have essentially been flat, right? You see that zero there. The managers, your managers collectively have generated a return of close to 5%. So pretty healthy outperformance, right, versus the benchmark. Look at that same figure for domestic equity a little bit further down in the exhibit. So domestic equities have done great, right? We all know that. They're up close to 46% over the last year. But your index and then your combination of active managers are up over 48%. So some incremental contribution there. Skip to the next page, and you'll see the same thing for international equity, right? Up for over almost 42% in a period when international markets are up a little less than 39. The REIT manager down at the bottom there, Cohen & Steers, right? REITs are up 33.6% over the last year. Your Cohen & Steers manager's up 37.6%. The story here, right, is you're getting kind of good incremental returns really across the portfolio, and that from our standpoint is always encouraging, right? It's not coming from an individual manager, it's not coming from a particular asset class, but it really is a kind of a testament, I think, to the disciplines of those managers throughout your portfolio and them all having done good work over the last year or so. So other than that, that's kind of... I don't have any recommended changes on the allocation front nor on the manager front for sure, and I think we've got lots of good evidence here that the program that you've put in place is working and working pretty darn well, all things considered. With that, I will pause and see what questions folks may have.
Barbara?
I have none.
Okay. Rebecca?
No questions. Thank you.
Mitch?
All good.
I have one, and it's not really a
You
question.
can scroll if you'd like.
No, I'll let you drive that.
Okay.
Just going back to the plans returns.
Yeah.
And just highlight, because, I mean, this is recorded also, but this isn't out for OGAT, so just comment, Chris, you know, and we don't want to leave everybody, especially given the last conversation we had actuarially, we don't leave everybody with the idea that we earn 20% a year for every year. Could you just comment on where we are relative to longer term, 10-year life of, you know, since really we've been working with you and following this approach, and how that ties in and value that's been added over the years, and just maybe comment on that a little bit.
Yeah, so I think, right, 27% is an enormous number, right? And it certainly, as the chair mentions, not a typical number. When you start to look at the longer dated numbers in the exhibit here, looking for the last 10 years, right, at an annualized basis, the plans returned a little north of 8%. Since inception in 2007, net of the manager fees, you see the number there of about 6.4%. So you see a lot of very robust numbers here, and really exclusively numbers north of what the action you just took related to the discount rate. Why that's not counterintuitive is what we talked about a little bit earlier. Valuations have gotten bid up for a lot of these capital markets because returns are so high. Interest rates, we know, are very low. On a go-forward basis, those hurdles make the challenges presented to generate these numbers that much more difficult. So remember back at the beginning of the year, we modeled the portfolio with your current allocations, and as we mentioned, I think in our conversation with Michelle, a number akin to 6%, probably on a go-forward basis, is about what we should expect from the program. So a little bit south, right, Mitch, of Eric, of a little bit south of what we've been doing. But I think it's kind of it kind of represents that balance of historically what's happened and then prospectively what may happen. And I think, again, it puts you in kind of a good place. There's been lots of value added. No doubt about it, right? Your managers in this committee's done a great job. And, look at this exhibit here. For the quarter, second quarter, year to date, 1 year, 3 year, 5 year, 7 year, 10 year, since inception, there's not a period where the managers have underperformed. That's about as consistent as a track record as you'll see, right? And, invariably, there's typically, time frames when there is a bit of underperformance. You see that a little bit in calendar years 18, 16, and 14. But you mold it all together, and the program that you've put together has done very, very well.
But interestingly, the benchmark that we follow, and if you go back to really since 2007, which is the long term, that benchmark is 6%,
right.
which is right in line with what our previous discussion was. So I think to reinforce the target of, looking over long-term up markets, down markets, where we are, I mean, that 6% number kind of just keeps coming back to, what to reinforce where we're going with things. So, although if you could get us 27% a year, I think that would make John very happy. It'd make his budget much easier, even if it was a little lower than that.
Yeah, it's been just an unprecedented year, right, and period on so many levels. We've talked about it in previous meetings. Who would have thought back in March of 2020 and given the circumstances that we would see capital markets bounce back the way that they have, but the stimulus is unprecedented. I'm not a doctor, but the stuff done on the healthcare front with the rollout of the vaccinations is kind of Herculean, I think, if you really think about it. And markets have come roaring back, and when you've seen when things have settled down a little bit, the macroeconomic data all explodes to the upside. So it's been pretty darn amazing.
Hopefully that makes your budget a little easier, John, going forward.
Where do you think we could have been, like Chris said, March, when the markets were down?
Yeah.
We were all closing up and all. We've been pretty resolute. Oh, I'm sorry.
That's okay. Any other questions or comments for Chris or his report? Nope. If not, Chris, thank you very much. We
Thank you, folks.
appreciate it. Just move.
Could you just stick around for our new business for a few minutes?
Sure. Chris, if you can stick around.
Whatever the board desires.
Yeah. Just make sure you turn on your microphone then. So moving on to our agenda, next item is new business, so anybody have items to discuss?
Yeah, I have one thing. Not at the last meeting, at the meeting before, we had talked about Mutual of America going to be looking to add different funds and all, and we were concerned about that. And I think we did have a quick little discussion with Chris, maybe Chris helping us with that. Do we want to move any farther on that now, or discuss it with Chris before the next meeting, because Mutual is scheduled to come to the next meeting? I'm not sure what they're going to present. I'm not sure if they're ready to move into all those funds yet or not.
Okay. I actually had a note to myself on the agenda to ask that same question, so we're thinking alike on that, because we did, and my follow-up was going to be what we had heard back from Mutual America about their new platform and if any of that had taken place as of yet.
We haven't heard anything yet from them on that. So I don't know
Okay.
if the COVID has slowed them up. I actually haven't talked to her in probably a couple of months now, which is unusual, but I can give her a call and see where they stand with that. The other thing, what we'll probably have in the next meeting is Wells Fargo also, and we'll probably hear a presentation on their purchase over to
Principal.
Principal. Yes.
So just to give a little background to the board, Mutual of America is the provider that manages the 401A, the defined contribution plan, which at this point for the town, the overwhelming majority of employees participate in, since the defined benefit plans, which we've just been talking about, have been now closed since, I think, 1997, Mitch? Something around there? Could be even earlier, yes. So, and really, since those plans were implemented, Mutual America has been the provider. We've really never gone and taken a look at that provider and what offerings or else are out there comparatively in terms of service, in terms of offerings of investments, et cetera. So we did raise the question a couple of meetings ago about, should we, or is it a time to at least explore the opportunity to see what else is available? Are we providing the best possible offerings to the town employees that we can at the best cost with the most options?
And conversely, there was some sentiment, I think, among the committee that there were almost too many options, and they were going to add more. And it's just overwhelming to look at 5, 6 managers in each space and expect employees to figure out how to balance this. So we were given some thought to the fact, if we stay with Mutual, should we get Chris's advice to have a slimmed down, more comprehensible list of choices so that people can really focus on what they want to do instead of having so many items that it's simply overwhelming.
Yeah, thank you, Barbara. Yeah, because I think they were talking about having about 70 or 80 different fund offerings, which, gets to be, kind of an extreme. And that, by paralysis, I think the industry says people tend to gravitate towards the most conservative, least risky thing they can find, which probably is not the best thing for their long-term retirement needs. And you end up, with money market funds and stable value funds being chosen as opposed to, well-designed options that provide a better return.
Or all equities and no balance.
Yes.
It was on the whole time. So I just want to add, since I actually am part as an employee of this plan, that there are those overwhelming number of offerings, but Mutual of America does also offer plans that they've created with specific retirement target dates. So it's not, I don't want people to have the impression that, employees are just kind of thrown into this situation where they're choosing from 70 things and, having to make these decisions.
But then again, if you pick a target date, which I'm not saying is a bad idea, if you don't want to think about it, in a sense, you're giving up all choice because you're letting someone choose for you.
Yeah.
So it would be nice to have something in the middle, was my point.
Yeah, I think that just in my conversations with people about the plan, people typically either choose the target retirement date plan because they're not knowledgeable enough about the different types of funds in order to make those choices, or they're extremely knowledgeable and they like the option of being able to select the things that they want. I don't think that we have too many people where they're, knowledgeable, they either are knowledgeable enough to choose what they want, or they lack the knowledge and they're not seeking the knowledge, and so they're just choosing what's been predetermined. That's just my own experience talking to employees.
The other, it's on now. I left that on. The employees also have twice a year where mutual representative comes down and they're able to sign up and sit down with them and go over what their options are. And if they can't make those dates, there's also a number they could call all the time and they could talk to somebody up in the mutual office. We've even had employees go up there and sit down in person with somebody up there and understood they got taken to lunch and everything else, that person, so another option. Mutual has serviced us very well. She has serviced us very well.
Now that John, is very encouraging, and also Rebecca, what you said is encouraging. That, first of all, having a representative from Mutual help guide employees is really important, and then, as Rebecca mentioned, having the milestone funds or target funds is also a good option for those that are overwhelmed or don't have the financial background and just say, what do I do? And that's what I would guide them to, is if you don't know what to do, go with the retirement date targeted fund. But on the other hand, as Barbara's saying, for those that are savvy or want to make those investment choices, having 20 or 30 choices is a lot. Having 50 of them is too many, in my opinion. So I think that's where we were headed for that, and that's what I think where Mutual is possibly heading to, having that many, I think, so.
But I think we could limit it. And that's where I think Chris would come in and he'd target the different areas of the mutual funds to say, okay, you have one or two of this group, one or two of this group. That's the way we used to do it where I was before, and that was how we were guided towards what we needed to do as the plan sponsor, as the fiduciary of the plan, and all that to keep it. And I think there were, and Chris, you probably speak to this better than me, I think there have been lawsuits in the past where employers have given the employees too many options, and they've kind of, I won't say lost money, but their returns were disappointing.
Yeah, there's certainly some of that. I guess I would offer up, and just stop me if I'm overextending myself here. I'd offer up a couple of things. I think we talked about potentially maybe doing a record-keeping search, just an exercise to go through. That very well mean you retain Mutual, or maybe you look at someone else, but you go into the marketplace and test what's out there given your asset size. And we do a couple dozen of those studies a year for other municipalities around the state. It would give you price discovery, right? How competitive their prices are right now. It'd give you discovery around the service team, offerings, the flexibility of the platform. the collateral they produce for the participants, right? And to what extent they're investing in getting good collateral out and supporting participants. So oftentimes when you haven't been in the marketplace in a long, long time, like you haven't, that's a pretty effective way to see what's out there from as a fiduciary perspective. What are the other options? Is what we have now competitive? And at the very least, right, it makes mutuals sharpen their pencil at the end of the day. There's nothing like an RFP in the marketplace to make your legacy provider know that they've got to kind of, put their best foot forward from both a pricing and a service proposal perspective. So that's one tack to take, or just on a retainer basis, if you're insistent on keeping mutual, we could go through that same exercise just internal to them and use our resources to just drive you to, make recommendations around improvements and other things. So there's, you could do it either way. We're indifferent. There are some nominal fees to that. I think, John, we may have shared those with you and Eric. I'd have to come back to, I don't remember what we provided with you. They're not particularly high fees, but there is a project fee for that. And I'd introduce a colleague of mine. We have a team that specializes in defined contribution consulting. So we have folks that just deal in that space. They know the record keepers inside and out. They know the pricing hot points. They know the service models. They know the investment platforms. And they'll bring you all that perspective. But we've got, I don't know, probably 30 defined contribution clients in the state of Connecticut, so we're pretty active in that arena as well.
And, especially if we do stay with mutual, I'd like for us to have some help selecting options that we're going to present to employees, because I think you're better fixed to look at fees and managers to pick 2 or 3 in each space. I don't feel the least bit qualified to even attempt doing something like that.
Yeah, my experience on the defined contribution side is that while we don't have the largest plan, we probably have close to about, John, about $25 million?
It's right in that area.
Approximately, which, we're not, again, like the defined benefit, we're not, there's a lot of big players that aren't interested in us, but the market for, the smaller plans has changed a lot over the last few years. Costs especially have come down dramatically. And a lot of it is, if you don't ask, you don't even know. If it's, if we could reduce the cost, let's say 5 basis points, but 5 basis points on $25 million is, that's a return directly to, all the participants. So, my feeling is, and relative to, what the costs are, and again, I'm not saying anything that we definitely should. I think Mutual America has done a great job. I think over the years, listening to them and they've been very responsive. When we've asked them to increase the number of visits from, I think it used to be once a year to twice a year, they absolutely delivered that. They are, everything I've heard back from feedback, Rebecca, from, through John and everything else, is that employees, for the most part, are happy with what they have, which is good. I'd like to operate from a position of strength rather than from a position of weakness. And I've been on this board long enough to know that we wouldn't always have that kind of relationship with providers and everything else. But that said, to explore and just get educated as to other options, my feeling is, I think that's part of our, really our job as a board to kind of at least
Yeah, I think we have a
explore.
fiduciary duty to examine what we have and make sure, although the track record of satisfaction is an important one, to make sure that we're getting the best net return for the participants is also very important.
So I guess the question would be, from the board's, how would you like to proceed?
A couple thoughts on that. One is the fact that Mutual America is coming to see us at our next meeting in November, correct?
That's correct.
So does it make sense for us to meet with them first? I mean, it doesn't sound like there's any imminent problem here, doesn't, from what Rebecca says and John says, we don't have a problem with Mutual America. So would it be best to hear from them first, discuss our concerns with them directly, see how they respond, and then potentially, Chris, you're at that meeting anyway, and then potentially maybe even Eric put on the same agenda if you want, discussion of review of defined contribution plan. And then if after that discussion with Mutual America, if we feel that we may not feel there's a need. If we feel then there's a need or desire still to go out and compare their services, their costs, their returns versus others in the market, then we would engage Chris. And by that time, in November, Chris, I would ask you to at least have a proposal for us. Whether we take you up on it or not may or may not happen. Have a proposal so we understand exactly what you mean by a small cost, to do this study, project cost, as you said. Then we would have an idea, and then we can make a more informed decision as to whether, I think we should take a look at this, or no, it's not necessary. I don't know if everybody feels about that.
So would the first step of the proposal be to evaluate Mutual and just see where they stand in comparison to other players in the field? And then once we have that, we can decide whether we go a step further and do RFQs? I'm a little confused
No,
as to what the scope would be.
my thought is, not to spend any money if we don't have to. No offense to Chris, who's sitting here. If we feel satisfied after speaking with Mutual about concerns that we have, and drill down on some of their, things that we're concerned with, which doesn't sound like that much. If we're satisfied, then our once-a-year meeting has given us satisfaction. If we feel that there's still a need to do some sort of study, then at that point we would engage Chris, taking a look at what the costs are, to do a study. I think this is what you're proposing, to do a study of, where Mutual America stands up against its peers in terms of returns, in terms of costs. The part about servicing the employees, I think we've already addressed as being satisfactory, so that may not come into the equation. But is that how?
Yeah, no, I might offer up, Mitch, just this one. This might help the conversation in the fall. Can we get, John? I'm sure we can from Pam or from whomever. Can we get their cost schedule? I mean, the actual record-keeping costs that they're charging, because I think Mitch, what you're going to find. My intuition, and if I remember correctly, when I had talked to my counterparts on the DC side, is that they tend to be fairly expensive in terms of the marketplace. And I could at least have that, John, basic line perspective for you in the fall on the heels of whatever other answers you get from them. I completely agree. What sounds like from the board's perspective, I have no idea where they're coming from with offering 50 or 60 funds. That's nonsense. It's certainly not best practices. Most plans have 15 or 16 funds, and that includes a suite of the target dates funds alongside it. As kind of providing that balance to not overwhelm participants, but I'm not quite sure they're completely off market with what all the other record keepers are doing, and certainly what consultants are recommending. Adding 50, 60, 70 funds, it makes no sense at all. I didn't understand that, honestly. But if I could work with you, John, maybe just on that fee schedule from Pam, at least we could come to that meeting, and after you've done your interviews and had your conversation, we could lend a little bit. Then there's no cost to that. We'll obviously just do that and give you that color and perspective on the heels of their presentation. So you've got that as one data point, and then maybe that triangulates around, where you come out in terms of what tack you want to take.
So then, Chris, with that thought process, would it make sense then, even getting that information from John back and forth, would it make sense for you then to have a proposal for us, or wait until?
Yeah,
action?
no,
Okay.
I will bring,
Okay.
I will absolutely, if it's the board's pleasure, I'll bring a
Well,
proposal.
that's one opinion. I don't want to hear from everybody
Yeah.
else, but that's just,
I think, I don't remember, I'm embarrassed to, John, I don't remember the numbers we talked about.
Yeah, I don't remember.
They were
it either.
not
I'm
huge, no, was it $7,500 for the project or
don't
something like that?
remember.
I don't remember what the
I
number
didn't
was.
think
Have to
Yeah.
adjust for wage inflation.
I didn't think we even talked
Maybe
about
we
that,
didn't,
but
it's
we could've.
typically something like that to do an RFI in the DC space.
By the way, John, and see, you chastised me for not bringing my big file. But they did include their costs in their report every year. So if I had that, I probably would be able to get that information for you. I think I know some numbers in my mind, but I don't want to quote it because I don't want to be wrong about it.
Where is it in the report they give us?
In their annual report, it was, and just so you know, range, it was somewhere between 70 and 80 basis points, I believe, that sticks in my mind.
I don't
but-
remember what they're charging per participant for
but-
record keeping.
But I don't remember
Yeah.
some of the other charges.
Yeah.
But I think that was all in their report, because we did talk about that. And my only comment, Mitch, to you is, yes, I agree that we don't have a lot of issues with them. But I think the unknown is, we don't know what other people are offering, that we don't even know what we could be entitled to or what we could get, that Mutual America has not even raised to us. It could be absolutely apples to apples, we're the same, but there could be some other things out there that we're just not even aware of. And
With
I don't know.
with that though, Eric, are you comfortable though waiting till November and having Chris give us a presentation about what it costs would be, or you want him to go forward with it now and have it ready for the November meeting? I mean, that's what I thought we might be heading, but I said let's do more fact finding ourselves.
Yeah. No, I'm comfortable waiting until November. I mean,
Okay.
I don't see that there's that much of an urgency. I think if ultimately we were having significant problems with them, that would change my mind. But because the relationship has been good, yes, I mean, I'm fine with the timing. My tendency is to say that even with that, I think we should go forward with it. But I'm comfortable waiting until November.
I mean, I think what'll happen in November, so Pam will probably come in with, I forget his name again, that actually gives the presentation, and then she'll probably talk about where they're going in the future, and she'll probably bring up these new funds that they want to bring in, and I think that'll give you the opportunity to question her on it and find out exactly what they're doing. I think maybe we misunderstood, even though they're bringing in these new funds into their portfolio. I don't think she meant that our employees are gonna have the option to pick from the 200. I think they were just gonna put some more into what I'll call play for our employees, but not all 200. That, like Chris says, that doesn't make any sense if they were to do that.
I got the impression, John, that it was, they're going to open up, they're going to expand the platform. It puts the burden on us to make that determination as to what it is. If we kind of punt on it, then yes, all those options would become available. I would completely agree that would not be the most responsible thing from this board's perspective to allow that. I think no matter what, we would need to kind of help to whittle that down to a bite-sized parts that we feel are good.
Well, then I would ask, as part of Chris's proposal, when he compares Mutual America to other like-minded companies that deal with defined contribution plans, to let us know how many funds they offer to the employees. Maybe it's a range based on the size of the employee base, based on the size of the portfolio, or maybe it's pretty strictly, 20, 30, or whatever. We can get a number. We can see where we're at in comparison.
And even further, if there is winnowing to be done, are we expected to do it? Because I don't feel good about doing it.
What people typically do when engaged in those settings is we help you design the menu and build it out.
Okay. I think that's a good way to go forward and handle it. And again, I don't see, like a sense of urgency that it has to be dealt with today. So I think that kind of gives us a roadmap to move forward, and we can take it from there. Rebecca, any comments? You're the one that's living this, so.
Yes, yeah. Just wanted to say, I agree. I don't think there are any problems. I haven't heard any feedback where people are upset
Okay.
with Mutual of America in any way. Not that people necessarily know to bring that feedback to me right now, but I don't think that there's any sense of urgency, but I do think ultimately everybody just wants to get the most return on their investment. And so if we think that there's call to explore whether we could be getting more from other companies, I think that's appropriate.
I would say, Rebecca, as a representative, as part of this process, and again, I don't think it has to be for the next meeting, but as you talk to employees, if there are, please, if there are any items that they see that they would like to see, within reason, obviously. We can't do everything, but that feedback as part of this process, could be educational, so we can make sure that those questions get asked if there is something that were to come up.
And is it worth at all someone shooting an email to Jeff, just saying, have you heard anything from the police side, feedback one way or the other? Just, even if he just emails us, at least we'll have the input from both sides.
I think it would be appropriate, and either John or I could do that. Unfortunately, I'm not sure we'll get much of a response. But I think to put it on the record and just make sure that we keep them informed, absolutely.
The police representative gets a copy of everything that we get here.
Just have a question for John, I guess. Do you think it would be feasible or appropriate to send a survey to employees that they might be able to fill out about their satisfaction with?
We could do it. I'm not sure what kind of response we
I'm
get.
thinking we'd have a
Usually-
pretty low response rate, but at the
Yeah.
very least, it might give
mean-
people the opportunity to weigh in about, maybe we're, imagining certain things about the way people participate or want to participate, their satisfaction or their dissatisfaction, and having, one, it gives people the opportunity to give us feedback, and two, it gives us the peace of mind of knowing that we asked for feedback, and if they didn't have any, then, we're able to make the decisions as we see
We could
fit.
do it. We could send it out just like we send out the invitation when they come in that one day, which
Yeah.
will be sometime in September usually. And if they're interested, they usually reply and call, and if not, they don't. That would be the same way with the survey. The other thing we gotta remember also, it's not just the town side, it's the Board of Education side also.
Sure.
They have, probably 50, 60 people in the plan on that side.
John, I think Rebecca's suggestion is a great one, because then, we're sitting here somewhat in a vacuum, except for Rebecca, because, we're surmising things about the plan, about the acceptability and how people feel about it, but at least putting it out there. And if you're going to be sending something out in September anyway, that's between now and our next meeting. So I think that works perfectly to get some feedback, and whoever chooses to give us feedback will be good. And if they choose not to, then that's fine too. Just we give opportunity, and we may learn things, and Rebecca may learn things that we don't realize, and maybe some little, or maybe some overwhelming thing that we're not hearing. So that's a great suggestion. I think it can't hurt to give that a shot.
Chris, has your group ever designed an employee survey like that you would have, or?
Let me look. We may have done something
so we're not reinventing the wheel.
Yeah, let me look. I can ask around tomorrow and see. We might have something that you could piggyback off of and use just a kind of a simple client, participant satisfaction survey or something like that.
Not looking to incur a lot of costs, but also not looking to kind of
Yeah, I don't
have to
think
create
you want
something.
too many questions either.
No,
because then
no.
No, that's like having too many funds.
Yeah,
I'm not envisioning anything big, just
I'm not envisioning anything.
Right.
I mean,
Yeah,
what you probably
five,
get is
7
something like
questions.
we're not making big enough match or something like that.
Yeah, right.
That's a whole different issue
Absolutely.
that has nothing to do with the provider. It's a collectively bargained issue. So we won't deal with that. So, okay, so I think we have a good pathway to move forward. And to that end, John, you'll contact, or you've already been in contact about them coming to the November meeting?
I've called them. We haven't set a date yet, though.
Okay,
Working on the schedule for
okay.
that.
And that'll be both for Mutual America
Oh, for
and.
November meeting, they'll be here, yes.
Yeah,
Yes.
and, but both for Mutual America and, I guess, Wells, as to give us an update as to the ongoing integration with Principal. So, okay. Any other items of new business to raise?
I had one, I think this is maybe more a question, and I apologize if this is common knowledge. But I'm just wondering about the pension plans. Are there regular cost of living increases to those plans? Or semi-regular? Do we know when the last time there was a cost
Well,
of living adjustment?
The benefits that are provided, to my knowledge, and whether or not there's a cost of living adjustment or not, are, I believe, part of each union's collectively bargained contract. So if the contract contains a cost of living adjustment, then that would apply. If the contract does not contain a cost of living adjustment, I don't believe the plans would automatically apply that. But I haven't looked at the plan documents in a long
I
time.
believe you're right, though. I believe you're right.
That's the only reason I ask is because I've been I'm the president of one of the unions, and I've been in negotiations on all of those contracts since 2010. And every time that has been brought up, it's been a while since we've had a pension person on the negotiating team. That was always discussed outside of those negotiations. So it was mentioned that those discussions need to happen at the pension board level. And so that was my impression.
I think it was part of the union negotiation, I believe. I mean, that was
Okay.
before my time also. but-
So John, first of all, the first question is, and I don't remember the answer to this, do any of the groups get a automatic cost of living adjustment? Be it the police, the Board of Ed, the
If
town?
it is, it's figured by Wells Fargo at the time.
Okay.
It doesn't come out of the town hall.
Okay. So the
So it's part of whatever the contract is
Right.
that the town holds with the police. I would have to go back and look at using the police again, their union contract to see what it says.
Okay. And then the follow-up question to that is really, because the vast majority of the pensioners are not in a union anymore because they're retired, it's not going to be something, for better or for worse, it's not going to be something that's going to be very prevalent in union negotiations if only 2 or 3 people are even in the union to be arguing for it. So it may very well end up in either our laps or the Board of Selectmen's lap based on however the pension plan is written. And like you said, I don't think we've looked at the plan itself in a while, but there's probably some caveat in the actual plan that would state, any adjustments to the plan, who has the authority to make those adjustments.
In Rebecca's case, her union has nobody left in
No.
the plan.
So does it mean
That's why Paul was the last.
Yes. Which is why it's been off my radar for
Right.
negotiations, because in the last time it was raised, in negotiations that I participated in, there was somebody on the negotiating team who was a pension person. And in that meeting with the previous finance director, he had said that it was something that was decided separately. It was not part of the contract negotiations. So that's just why I wonder, if those adjustments are happening, if they're happening across the board, if they're not happening at all because everyone thinks someone else is talking about them.
Well, since I've been here 5 years, and if it has to happen through my office, I don't believe it's been happening because I haven't signed off on
And
anything.
I've been on this board for over 20 years, and that has not come up at
Okay.
any pension board meeting.
Okay.
But what I will suggest is, and maybe John, if we could ask the town attorney to look at the plans and give us some guidance on that. Is it in fact an item that can only be bargained, or is it something that either this board or the Board of Selectmen would need to discuss and possibly address?
To
get a clarification.
I have since we don't know of any action in 5 years, I think it's probably automatic already through the plan, and it's probably happening, but I'll check on that
Or,
tomorrow. I think.
or an answer that it's an automatic and taken care of, but,
Yeah.
I mean, I
I
get,
think the
sure.
answer may lie in my office with my associate.
Okay.
So let me start with her tomorrow.
It's certainly not a criticism. It's definitely a question. More so, I just want to make sure that that's happening. And if it's not happening, that we discuss the remedy.
sure. I think this is the perfect forum to raise the question, and yes, we'll look into it. Sure.
Great.
See what, get a clarification on that and see how that comes out.
Great.
So, any other items to discuss or any other questions? If none, I would entertain a motion to adjourn.
Motion to adjourn?
Second?
All in favor?
Aye.
Aye. Thank you. Our meeting is adjourned at 8:34, it looks like. Thank you.